The customs valuation methods. The customs value is the value to be determined for the purpose of applying the ad valorem import duty tariff. It serves as a basis of taxation, that is, as a basis or basis on which customs duties are calculated. Consequently, value is an important element of customs matters, the determination of which has three interests, namely: a tax interest by determining the exact amount of import duties to be collected when the goods are cleared through customs; an economic interest by promoting international trade through the application of precise and non-arbitrary assessment methods; a statistical interest, through the calculation of the statistical value, essential data for the establishment of the trade balance, in particular data on the value and volume of trade. The obligation to declare value results from the provisions, which list the elements of the basis for calculating import duties and similar taxes, including qualitative elements: origin, provenance, species, etc., and quantitative elements, namely value. What are the supporting documents for the declared value? For the control of the declared values, the customs shall check the documents attached to the customs declarations, namely, invoices relating to the declared goods. It should be noted that with the widespread use of electronic invoicing and the transmission of documents by fax or email, the very notion of original document is losing its meaning and becoming almost unverifiable. The principle was therefore adopted of accepting invoices sent by courier or fax, provided that they are signed and sealed by the importer, or by a person authorized by him for this purpose. However, it is understood that where there are serious indications that the authenticity of the document presented, or the information contained therein may be in doubt, the customs services reserve the right to require the importer to produce the original invoice. Where the customs have doubts about the veracity or accuracy of the information provided in the invoice, it may request the importer or declarant to provide additional supporting documents, contracts, notices, documents, or any other evidence. The presentation of an invoice is not mandatory in the following cases: goods imported as duly justified donations, goods imported by travelers in the case of non-commercial transactions, family shipments and gift packages. The methods for determining the value of the imported goods. The national import customs valuation systems are based on the Agreement on the Implementation of Article 7 of the General Agreement on Tariffs and Trade, which was adopted in 1979 following the Tokyo multilateral trade negotiations, and entered into force on 1 January 1981. This agreement aims to set up an evaluation system: 1. Fair, that is based on real business practice; 2. Uniform, since it is based on customs valuation methods that meet simple criteria; 3. Neutral, in the sense that it aims to avoid artificially increasing the customs value. This agreement prescribes 6 valuation methods, to be applied in the order in which they are set out until one of the first methods, that allows the determination of the customs value. These methods are: 1. The transaction value of the imported goods; 2. The transaction value of identical goods; 3. The transaction value of similar goods; 4. The deductive method; 5. The calculated value; 6. The residual method. These negotiations led to the creation of the World Trade Organization (WTO) in 1995, and resulted in the World Trade Organization's Agreement on Customs Valuation. First method, the transaction value of imported goods. The customs value is constituted by the transaction value, that is the price actually paid or payable for the goods, when they are sold for export to the taxable territory after adjustment. 1. The notion of sale. The use of the transaction value necessarily implies that the goods to be valued have been sold. However, the provisions of the World Trade Organization's Agreement on Evaluation do not provide any definition of the term sale. Instead of seeking a definition of this concept, it seemed preferable to establish a list of cases that are not deemed to be the subject of a sale, such as free deliveries and where transactions do not involve the payment of a price, such as the case of gifts, samples and promotional items. Any operation to import the goods carried out by a branch, which does not have a legal personality distinct from the exporter, cannot be considered as a commercial sales transaction. Goods imported on loan and remaining the property of the shipper do not constitute sales. In view of the above, it appears that only commercial transactions involving an effective transfer of goods at the international level with a transfer of ownership of imported goods in return for payment of a price can be valued under the transaction value method. 2. The notion of price actually paid or to be paid. Transactional value is defined as the price actually paid or payable for imported goods. It is a done, concrete, real price and not a normal or usual price. The price actually paid or payable shall be understood as the total payment made at the time of customs clearance, or to be made after that date by the buyer to or for the benefit of the seller for imported goods. This price includes all payments made as a condition of the sale of imported goods. This payment can be made by any means of payment, and can be made directly or indirectly. Therefore, all discounts, rebates and discounts granted must be allowed as a deduction from the price in question. The transaction value, which should, as far as possible, form the basis of the customs valuation, is only acceptable if the four conditions laid down are met. Condition 1. No restrictions concerning the purchase or use of goods by the buyer. In the same way as restrictions are imposed by law or the authorities of the importing country or geographical region in which the goods may be sold. Condition 2. The sale or price is not subordinated to conditions or benefits of which the value is not determinable. Where the customs value of the imported goods cannot be determined on the basis of the transaction value, because the sale or price is subject to conditions or services the value of which cannot be determined. For example, when, A in the case, the seller establishes the price of the imported goods, by making it subject to the condition that the buyer will also purchase other goods in specified quantities, or, B in the case the price of imported goods depends on the price at which the buyer sells other goods to the seller. Condition 3. No part of the product of any resale, disposal or use of the goods by the buyer directly or indirectly reaches to the seller. This provision applies, in particular, to cases of profit sharing between seller and buyer. Condition 4. Existence of links between the buyer and the seller. The nature of these links is the subject of a restrictive list. Persons, whether legal or natural, shall be deemed to be bound for the purposes of applying the above-mentioned mechanism, only if one is a member of the management of the board of directors or the management board or the supervisory board of the other's company, and vice versa. They are legally partners. One is the employer of the other. One of them controls the other directly or indirectly. Both of which are directly or indirectly controlled by a third party. Indeed, a person is deemed to control another person when he or she is, in law or in fact, in a position to exercise a power of coercion or direction over him or her. The adjustments to the value. If the principle is that the value for duty of the imported goods is the transaction value, some adjustments may be made. The adjustments are grouped under the following headings. 1. Commissions and brokerage. If the sales commission or brokerage is separate from the price of the goods and is due in addition to the price, the invoice price should be increased by the amount of the commission, to determine the transaction value. 2. Containers and packaging. The cost to be incorporated in the value of the goods is constituted by 1. The value of packaging when it is not reusable. 2. The cost of their use when they are reusable. Where packaging is taxable at their own rate of duty, its value and the cost of its use shall not be included in the value of the goods. 3. Products and services provided directly or indirectly by the buyer at no charge or reduced cost, It may also happen that the manufacturer has received free or reduced cost products from the buyer that he has incorporated into the goods to be valued, and has therefore not taken into account the value of these products when issuing his invoice. 4. Redemptions and license fees. 2 cumulative conditions are set for royalty to be added to the price actually paid or payable, namely, 1. It is related to the goods to be valued, and 2. That it is a condition of the sale. 5. Product of revenue. The price actually paid or payable for the imported goods must be increased by the value of any part of the product that is subsequently resold, transferred or used by the imported goods, that accrues directly or indirectly to the seller. 6. Transport and other costs related to the delivery of the goods shall be added to the price actually paid or payable for the imported goods to the extent that it does not include them. The costs of transport and insurance of these goods, where they are introduced into the taxable territory. The loading, unloading and handling costs associated with the transport of the latter to the place of introduction into the taxable territory. The other valuation methods. The principle. The declared value must be the subject to the preliminary verification of the declared value, is carried out through its reconstitution. This reconstruction makes it possible to 1. Verify that all the information contained in the documents annexed to the customs declaration, in particular the invoice, is in conformity with that contained in the customs declaration particulars. 2. Allocate values by item to avoid value shifts. This concept refers to the possibility for the importer to be able to artificially inflate the value corresponding to an item subject to a reduced tax rate, and therefore reduce that relating to another item subject to a high tax rate. 3. To avoid both shifts tending to evade duties and taxes and increases in values, by artificially increasing the value of goods and/or the associated costs of items that are subject to reduced taxation. Determination of the total value. It results from multiplying the invoice value by the exchange rate, increased by the amount of freight, insurance and costs associated with unloading the goods. Total value invoice value x exchange rate plus freight plus insurance plus related costs. The preliminary verification of the declared value may lead to an adjustment of the declared value in the case of, in particular, the non-integration of one of the elements constituting the customs value, such as the total amount of transport and other approach costs. The false declaration of value. The adjustment of the value following the result of the visit excess weight, false declaration of species, origin, etc. The rejection of the transaction value may take place either at the time of customs clearance or during the deferred or subsequent control. The second method, the transaction value of identical goods. Where the customs value of imported goods cannot be determined, the customs value shall be determined by comparison with an identical transaction other than that relating to the goods to be valued. The term identical goods refers to goods that are the same in all respects, including the physical characteristics, quality and reputation, as the goods being appraised. Minor differences in appearance do not prevent goods that otherwise conform to the definition from being considered identical. The goods are considered identical only if they are produced in the same country as the goods to be valued, possibly by the same producer. Where the use of this method does not allow the determination of the customs value, the following method should be used. The third method, the transaction value of similar goods. This method is in all aspects similar to that of identical goods except for the nature of the goods to be used for the comparison of values that are similar rather than identical under this method. Similar goods means goods produced in the same country as the merchandise to be valued which, although not identical in all respects, have similar characteristics and are made of similar materials, thereby enabling them to perform the same functions and be commercially interchangeable. For example, rubber hoses of the same size range are imported from two different manufacturers, both of which are located in the same country. Although each manufacturer uses a different brand, the tubes manufactured by them are of the same type, quality and reputation and are used by car manufacturers in the country. Although they are not the same in every respect, tubes actually have similar characteristics, and are made of similar materials, allowing them to perform the same functions. Since the goods are of the same type, quality and reputation, they must be considered similar even if the marks are different. The fourth method, the deductive method. This method consists in establishing the customs value on the basis of the unit price corresponding to sales in the taxable territory of the imported goods or of other identical or similar goods. In this case, the customs value is determined on the basis of the selling price in the taxable territory of the imported goods or identical or similar goods in the state in which they were imported. The relevant sale must have been made at or about the same time as the import of the goods to be valued. If there is no sale at or about the same time, the unit price at which the imported product is sold in the taxable territory at the earliest date following the importation of the goods to be valued shall be taken into account. The term earliest date means that it is within 90 days of import. The fifth method, the calculated value method. The calculated value method, which is the most difficult and rarely used method, makes it possible to determine the customs value on the basis of the cost of production of the goods to be valued, increased by a certain amount for profits and overheads equal to that which generally enters into sales of goods of the same kind or kind from the exporting country to the taxable territory. Production cost value of materials plus manufacturing operations. If not included in the above headings, packaging costs and charges, inputs and support elements, art and engineering works, etc., carried out in the importing country must be added. The sixth method, the residual method. In the event that all these methods have been exhausted without result, or have proved inapplicable for any reason, the so-called last resort method may be used. The customs value must, in these circumstances, be determined by reasonable means consistent with the provisions of Article 7 of the GATT 1994 Agreement. Reasonable means include 1. The customs values determined must be based on previously determined customs values. 2. The evaluation methods must be those predefined but applied with reasonable flexibility. 3. The condition that the goods must be sold in the same condition as they were imported could be interpreted flexibly.